Riches or recession? The second half of 2024 is promising riches, not necessarily recession, and here's why. Historically, July is a strong month for stocks. The first 15 days of July usually are the best trading period of the year since 1928. The S&P 500 has been positive the last 9 Julys in a row, 72% of the time. When you've got a strong first half of the year in the S&P 500, and it was up about 15%. In the second half of the year, you can expect a gain of 9%. Again, that's 72% of the time. Now, when you look at the NASDAQ 100, it's been positive the last 16 Julys, averaging about a 4.6% return. So right now, you can expect riches in the second half of the year. What's driving all of that? Well, first, on Wednesday, we get the June FOMC minutes. We're going to finally find out exactly what the members of the FOMC, the Federal Reserve, are thinking about in terms of a rate cut. There's a whole lot of talk that there will be a 25 basis point cut in September, but it's not a guarantee. First, let's look at what's driving the FOMC decision and how that will then drive stocks. Core PCE was up 0.1% in May. It's up 2.6% from a year ago. That's important for the Fed. When people heard that report, they were thinking, okay, the Fed's policies are working. However, we still see incredible increases in the price of housing. It's going up. Wages are still going up, and that puts pressure on inflation. It's why you want to watch for the jobs report on July 5th, Friday, because if you continue to see pressure on wages, that gives the Fed room to say, we don't want to cut rates. If, however, core PCE in June, that's their preferred inflation measure, if it should go up 15 to 20 basis points, that would add fuel to the fire, supporting a rate cut in September. Again, FOMC minutes will let us know what the members of the Fed were thinking when they met just 3 weeks ago. So here's the potential upside for stocks, and some you might want to consider, some that the herd is perhaps missing. First, there's the Mag 7. Microsoft, Amazon, Meta, Apple, Nvidia, and Tesla. Of course, they lead the charge. You should remember, too, that megacap tech drove 60% of S&P 500 gains in the first half of 2024. Don't expect that to change in the second half of 2024. When we look at the various analyst notes, they all say those mega tech stocks are going to be driven by what people refer to as the fourth industrial revolution or the AI revolution. Dan Ives over at Wedbush, he loves this. And he says the race is on for the first $4 trillion market cap company. And he's questioning, who will it be? Microsoft, Nvidia, or Apple? Take your pick. They're all on track. But here are the stocks that the analysts, when we look at their notes from Citi, from Bank of America, from Wedbush, here are some stocks that perhaps the herd of investors are overlooking. Let's start with Palantir. They just landed a 5-year extension of their contract with the Department of Defense, the U.S. Army. Remember, they're part of the system that's going to bring AI to the battlefield. Well, their Maven Smart system at Palantir, that deal for them is worth $480 million. So keep them in mind because they are a key player in the Army's battle to bring AI to the front. The other thing, though, is the stock advanced 47% in the first half of 2024. So there's room perhaps for growth given the fact that they've just landed that contract extension. CrowdStrike. They have new partnerships with companies that open up markets in Latin America. Their earnings are projected to grow 34, almost 35% annually, and that's outpacing, obviously, the indexes. Their stock also is trading at roughly 50% gain year to date. So you want to keep an eye on CrowdStrike. The revenue stream has also grown 34% year over year. It's now up to $3.44 billion. Here's one if you like a little bit of risk and you got some Pepto-Bismol to the side, Zscaler. First quarter revenue, if you take a look at their filing with the SEC, $553 million. It was up 32.15% year over year. They continue to post double-digit year-over-year sales, and they've done that, by the way, in several quarters. So there's a lot of betting money on them, but there's risk. This is a volatile stock. Over the last 52 weeks, the stock has had a move of 5%, a move greater than 5%, 13 times. So keep that in mind if you're willing to dive into this one. Billings, by the way, are up 30% as we head into the next quarter for them. As you consider what might throw all of this up in the air as we head into the second half of the year, first, in a little bit, just about 2 weeks away, we begin second quarter earnings season. Up first will be the banks. Pay attention when they report their loan loss provisions data. That will give you a sense of what's happening with the consumer in this environment. If loan loss provisions are increasing, the banks are seeing people default on their loans. That's a bad sign. You also want to take a look at what's happening with the indexes. We peaked as far as stocks hitting 52 weeks high back in March. 23% of the stocks on the S&P 500 hit a 52-week high. It was down to 5% in June. Keep that one in mind as you're picking stocks to go forward. On Friday, we're going to get the latest numbers on the Labor Department and jobs, what's going on with unemployment. Again, one of the things you want to look for in that report, everybody reports the metric about what's going on with the unemployment rate. Look for what's happening with wages, wage growth inflation. That's what the Fed is going to be looking at. The other thing you want to pay attention to is in mid-June, we got the latest update from the Congressional Budget Office, the CBO, telling us that the economy will continue to grow, but it's going to grow more slowly in the second half of the year. The other issue it looks at is consumer spending. Consumer spending, it says, will slow down in the second half of the year. Now, here's the problem with that. Usually in the summer and the winter, think about all the Christmas gifts you have to get for your kids, you see consumer spending going up. So we have CBO telling us consumer spending is going to grow more slowly in the second half of the year. And yet we have those two very strong forces, your summer vacation and then your Christmas holiday winter spend, all coming into play.